Just like before, the test likes you to know the following are never IAs. The following are never IAs. So instead of telling you who is, they tell you who is not. Isn't that how lawyers talk? Yeah. Investment advisor representatives are never IAs, meaning if you were to start your own firm, it's a legal entity that exists above you. Banks, savings institutions, and trust companies are never IAs. It's a separate legal entity. There is an exclusion for certain professionals, lawyers, accountants, teachers, and engineers. So we remember it with this funny acronym of LATE. Lawyers, accountants, teachers, and engineers whose investment advice is solely incidental to their job do not fall within the definition of investment advisor. So if the teacher gives investment advice not incidental to her job, then she would fall within the definition of investment advisor. Not all broker-dealers have to register as investment advisors if they don't charge a separate fee. So sometimes they do, but not always. If no separate fee. I'd say most are, but not all. Publishers of financial publications of general, regular, and paid circulation are not investment advisors. So Fortune, Money, Kiplinger's, they're not investment advisors. They don't give specific advice on your portfolio. Persons who have no place of business in this state. So this is an IA, once again, out of New York, can come into this state and do business with as many institutional clients as they would like. No registration is necessary. There is, for the investment advisor and for the investment advisor representative, what we call the state de minimis rule. I said that for the broker-dealer and for the agent, there is no de minimis rule. So be careful. If you have a client that lives in another state, you must register in the other state as an agent. But as an IAR, you can have up to, and as an IA, up to 5 public clients in another state without registration. So they like this concept on the test. So you work for an IA that's registered in California. You're an IAR registered in California. You have 4 clients that live in the state of Oregon. Can you do business with them? Yes. Do you need to register in Oregon? No. Could you have 5 clients in Oregon? Yes. You still wouldn't need to register. You can have up to 5 public clients. Another way of saying this is that you can have less than 6 public clients. So if you have 6 clients in Oregon, then you would need to register as an IAR in Oregon, and your firm would also need to register as an IA in Oregon as well. So your firm might have already had to have registered in Oregon. If you had 5 clients, it's highly likely that someone else that works for the same IA had a client in Oregon as well. So the de minimis rule at the state level for IAs and IARs, it does not apply to BDs and agents. Be very careful. Who falls within the definition of an investment advisor representative? Any partner, officer, director, or other individual employed by or associated with an investment advisor who gives investment advice or makes recommendations, who manages client accounts or portfolios, determines which investment recommendations or advice should be given, offers or sells investment advisory services, or supervises employees involved in any of these activities. Please note, clerical staff, trainers, and administrative persons are not considered to be IARs under state law. They are not considered. Trainers at an IA are not considered IARs. They do not need to be registered. An issuer. The issuer could be the U.S. government, it could be a municipality, it could be a corporation. It's any person who issues or proposes to issue any security. So they need to raise money, so they issue stock. The first time the shares trade, they trade in the primary market. We call this an issuer transaction. The National Securities Markets Improvement Act, it was passed in 1996. It's sometimes called on the test these days the Act of 96. It was this act that designated a federally covered security and a federally covered advisor. So we talked about how the dollar amount will be changing for the federally covered advisor. Net capital is how much cash and readily convertible into cash the firm must have on hand for customer protection. So net capital rules apply to broker-dealers and investment advisors. After a share of stock sells in the primary market, it goes into the secondary market. So this is the shareholders selling securities between each other, shareholder to shareholder. We call it a non-issuer transaction. So the New York Stock Exchange and over-the-counter are the primary secondary markets that we're concerned about. Offers/sales. An offer includes every solicitation to sell a security for value and every solicitation of an offer to buy a security for value. So an offer could be to buy or to sell. You could say no thank you, then it's not a sale. The sale is the act of conveying ownership for money or other value. Sales include any security given or delivered with or as a bonus for the purchase of securities or merchandise is considered to have been offered and sold for value. A gift of assessable stock is considered to be both an offer and a sale. So I gift you shares in my company. They're assessable shares though. If I ever need the money, you've got to pay me $20 a share. I might never ask you to pay me, but I might ask you to pay me. So by your accepting a gift of assessable stock, it is both an offer and a sale. Every sale or offer of a warrant or right to purchase or subscribe to another security or a security convertible into another security is considered to include an offer of the other security. What was that? Rights are offers of common stock. Warrants are offers of common stock, and convertible bonds and convertible preferred stock are also offers of common stock. Sales and offers to sell do not include a bona fide pledge or loan, like using stock as collateral for a loan. So in a margin account, you pledge your stock as collateral for a loan. It's not a sale. It's not an offer. Sometimes a corporation will declare a stock dividend, generally because they're cash poor. A stock dividend is not a sale, it's not an offer. There's nothing that you have to pay. There's nothing of value given when you receive a stock dividend. Stockholder-approved mergers or the sale of corporate assets in consideration of the issuance of securities of another corporation, or any consequence of a judiciously approved business reorganization. So once upon a time for fun, I bought my oldest son, when he was little, a share of Pixar stock, and I stuck it on his wall. And then along came Disney, and they bought Pixar. So he still has the Pixar stock because it's really cool. But he doesn't own Pixar stock. Now he has Disney. That was not a sale. That was not an offer. Didn't have to pay anything extra for that. A person. Person is broadly defined under the Uniform Securities Act. It's almost easier to tell you who is not a person, and then everything else is a person. A minor child is not a person. That's weird. No, it's this idea that they can't buy securities for themselves. They'd have to be in an UGMA or an UTMA account. An incompetent person is not a person. They couldn't have their own account. And a dead person is not a person anymore. Everything else is a person. It's very broad. An individual, a corporation, a partnership, an estate, an association, a fund, a joint stock company, an unincorporated organization, a trust, a government, or a political subdivision. So don't just think of yourself when they say person. It could be any of those. A prospectus is required to be given out whenever you sell a new issue. A prospectus is a summary of the registration statement. It has the things that a reasonable and prudent person would want to know to make an investment decision. You're required to give out the prospectus because of what I like to call the Paper Act. That's the Securities Act of 1933. This is the one that required the registration statement be filed. It also requires that you give out a prospectus. A registered representative, an agent. I told you this was with a Series 6 or Series 7 license. So for FINRA registration and examine licensing purposes, a registered representative refers to all associated persons engaged in investment banking and securities business. This includes all securities salespersons, individuals who supervise, solicit, or conduct business in securities, and individuals who train people to supervise, solicit, or conduct business in securities. So I need to make a point here. Was trainer included within the definition of IAR? No. So a trainer at an IA does not need to be an IAR. What about a trainer at a BD? Do they need to be an agent? Yes. So it's that kind of stuff that they like on the test. Anyone who is not a principal, so your principal would have either their 24, if you have a 7, they have a 24, or a 26, they're your boss if you have your 6. So if you're not a principal and you're not engaged in clerical or brokerage administration, then you're subject to registration and exam licensing as a registered representative. I said that the Securities Act of 1933 is the law that requires federal registration. The Uniform Securities Act is the law that requires state registration of a security. And there's 3 types of registration that you need to be comfortable with. There's registration by coordination. There's registration by notification, which is sometimes called notice filing or just plain old filing. And there's registration by qualification. So I would be comfortable with these 3. Know these 3. Coordination, notification, and qualification. Because you're going to be in there in the test, and there's going to be a choice of something like justification. And you're going to think, ification, I'm not sure if No. Justification just sounds good. It's made up to trick you. So I'll tell you some stories here. Back in the old days when I was little, I grew up in Oregon, and running's a big deal there, so I used to run in all these track meets. And I would qualify for the State Junior Olympics and the State Jesse Owens meets, and I did that a lot, and then I grew up and now I'm slow. But back in the day, I used to be able to run fast. So if you're going to register a security to be sold in one state only, there's a point to that story. If it's an intra-state offering, so maybe you were a wrestler and you qualified for the state wrestling match, or you were a swimmer or something like that. The stories just help us to remember. Registration by qualification. The full registration statement is filed in the state. The security is going to be sold in one state only. When can it be sold? When it is cleared for sale by the state securities administrator. Does the administrator approve anything or anyone? Never. That would open them up for legal liability. They simply clear the issue for sale. So if it's going to be sold in one state only, we call that an intrastate offering. Registration by qualification. If a security is going to be sold in more than one state and the issuer's never sold securities before, they're going to do this one. It's called coordination. They're going to file a full registration statement with the SEC and a full registration statement with the state. So they're basically coordinating. They're doing the same thing at the state and the federal level. When can a security registered by coordination be sold in this state? When it is cleared federally for sale by the SEC. So even if the state had cleared it earlier, they have to wait around for the SEC. This is what we call dual regulation, dual registration, anytime the security is registered in more than one state. Sometimes an issuer has already sold securities before, so we're going to give them a break at the state level. So if the issuer has been in business for a minimum of 3 years and has sold securities before, they're going to do registration by notification. They're going to file their full registration statement at the SEC level. But at the state level, they only have to do a notice filing. So we give them a break because they've already sold securities before. They're been in business a minimum of 3 years. We don't require them to do coordination anymore. They're obviously going to be selling more shares in more than one state. Under registration by notification, when can the security be sold in this state? When it is cleared federally by the SEC. So anytime it's dual registration, we always have to wait for the SEC. We know the Securities Act of 1933 is the federal securities law requiring registration. The SEC oversees the entire securities industry. They enforce all federal securities laws. The SEC does not enforce FINRA laws. FINRA enforces FINRA laws. The administrator does not enforce FINRA laws. The administrator enforces the Uniform Securities Act, state securities law. You have to be registered as an agent to sell securities. So what's a security? By definition, it's any note, stock, bond, investment contract, debenture, certificate of interest in profit sharing or partnership agreement, negotiable certificate of deposit, collateral trust certificate, voting trust certificate, pre-organization certificate, options. All options are securities. Commercial paper is a security. Interest in oil and gas drilling programs, those are usually limited partnerships. Those are securities as well. Gold is a commodity. There's a different license required to sell gold, so be careful. Options are securities. Variable annuities are securities. Fixed annuities are not. So if all you sell is fixed annuities, do you have to be licensed as an agent? No. So be careful. They love that on this test. If you were to go into the secondary market and buy shares of stock, why do you do that? What do you expect? You expect to make money. And how much say do you really have in how the company is managed? Little bit, not much. So it's what we call the Howey test that determines whether or not it is a security or not. It says that if we invest with the expectation that by the management of a third party we'll have more money in the end, then that is a security. Nobody can manage gold. Gold is a commodity. You can't change the inherent nature of commodities. The North American Securities Administrators Association has written statements of policy. The statements of policy, they describe to you dishonest or unethical business practices. So there are things that the NASAA does not want you to be doing. But they make this whole list. There's a whole chapter that's dedicated to these. These are things you will not do to make sure that they've told you what was wrong. And then, of course, at the end of the list, they're going to say, it does include everything. There's other bad things. Please don't do those as well. So no forgery or embezzlement. You need to engage in your business with high standards of commercial honor and just and equitable principles of trade. So they're trying to set forth moral guidance, which is good because there's always a few bad apples and they get a lot of press. So we'll do a whole section on statement of policy. So that concludes our definitions section of the Uniform Securities Act. Make sure you practice this section quiz. Have fun.